Now that small cap stocks have gone up, like I said they would, look out for the FUD. But is there a real risk here? Several weeks ago on June 23rd, I published this video, link in the pinned comments below, and in it I predicted that small cap stocks were likely to start moving higher soon. Well, since that time, that's exactly what has happened. But now the mainstream media is starting to spread fear, uncertainty, and doubt. Oh, and by the way, the overall stock market is down about 3% from its recent peak. So what's that about? Why all the FUD, and should you pay any attention to it? In this video, I'm going to tell you why there might be some truth to the FUD and what you can do to protect yourself in case it actually becomes true, which I currently place about a 30% chance of happening. Here's the problem. The economy is showing signs of cooling, as I've discussed in several of my videos over the past several months. Links to some of them in the pinned comments below. If the economy falls into a recession and the Fed lowers rates aggressively as a result, the stock market will view that as a bad sign, and stocks, both large and small cap, will sell off. To better understand this, let's take a look at the history of short-term interest rates, shown here in purple, where the Fed controls things, versus the S&P 500, shown here in this kind of off blue color, and the Russell 2000, shown in orange here, which are small cap stocks, going all the way back to 1960. Now, the Russell 2000 index hasn't existed that long, so I'm going back as far as it'll go back here. But let's take a look at what's happened going back. Let's start with this first fairly big drop here, and look at what the Fed was doing back here in 1967. It was raising rates, even as the equity markets were falling. And what did they do? They waited till almost the bottom to start reducing rates here. And then finally, when they started reducing rates, the stock market started taking off. But there was quite a bit of damage done here before they started finally reducing rates. So I'd say they got it wrong here. What about here? This was a very big drop, almost 50%, maybe 50% here. And you can see that the Fed was raising rates right into this drop in the markets. Now, right at the bottom, they finally started dropping rates and the markets started rebounding. So I would say, again, the Fed got it wrong here. But then, obviously, the famous late 1970s, early 1980s, you can see that short interest rates, T-bill rates, risk-free rates went up to 17% is where they peaked out. That's insane. And you can see that they eventually started to fall off. We're going to ignore this period because that was a highly unusual period. Now, where's the next time that we had a big drop? So now I'm going to go to a slightly more expanded chart where we cut off the earlier dates so we can look at the dot-com bubble back here from 2000 to 2003. You can see as the markets were moving higher, the Fed was starting to raise rates here. Now, the market started to drop, the bubble started to burst, layoffs started to happen, and the Fed waited till all the way out here after the markets had already started pulling back substantially to start lowering rates. And you can see that the market declined, I think it was about 45%, somewhere like that back here. But I think the Fed did respond fairly aggressively, but it was too late. The markets were already on a downward trend, and a lot of this was caused by the contagion of dot-com bubble companies being way overvalued with no earnings, and they were going bankrupt. So yeah, some of this was justified here. Now, take a look at 2007 to 2009. Again, the Fed's increasing rates going into this, and as the market started to turn, they started to reduce rates here, but didn't really get aggressive until the market really started to tank. And by then it was too late. And they really dropped rates aggressively here. The markets bounced, came back again, and the Feds really dropped rates in fear of the recession getting even worse. And then what happened? The markets took off and headed higher. Now, I would argue in both of these cases, the Fed waited too long to become aggressive about lowering rates. So what happened out here during COVID? Well, you can see that well before COVID, they started raising the rates again. Now, for some reason, before COVID really became obvious, at the beginning of 2020, the Fed actually started lowering rates again. And by the way, I would argue that they should have started raising rates back here somewhere in 2010, 2011, but they didn't. They kept rates at zero. While the markets were and the economy were doing extremely well, they should have been raising rates back here, but they didn't. They waited all the way till 2016 to raise rates. And then for some reason, they started pulling back again here right before COVID. But you can see what happened as soon as COVID became obvious. They dropped rates not only to zero, but to minus you can't quite see it here, minus 0.11%. That's insane. That means if you lent the government money by buying 90-day T-bills, risk-free T-bills, you would have to pay the government money. They wouldn't be paying you money. That's insane. Now, what happened? The markets recovered very, very quickly. A couple reasons. Rates are basically at zero. They were negative for a little bit. And we became more knowledgeable about what COVID was, how it was transmitted, and how it worked. And also some of the vaccines started to come out. So people realized that the economy was going to be okay. And you can see that stocks just had a very violent rebound here, which was fabulous. Now, I'm pointing at small caps, but you can see the same thing happened here with large caps. But what you will notice here is that when small caps went up, they went up a lot faster in general than large caps, and then they sort of flattened out, and the large caps continued higher. Now, where are we now? Well, we all know the Fed raised rates from about 0.08% back here, actually 0.03, ouch. I was using 0.08 as my base. But anyway, let's call it 0.08, all the way up to 5.3 or 5.33% up here. And that's a 67 times increase, which is insane. And you can see what it did to small caps and to large caps. The equity markets just got trashed as interest rates went up. But now they flattened out, and there's hope, obviously, that the Fed's going to start lowering rates. And you can see the markets responded by moving higher, except for small caps, which kind of barely went up, but kind of went sideways. And you can see right here have started to shoot higher. So how can you manage the risk in this current opportunity and take advantage of a potentially large upward move in small cap stocks? Well, first of all, as I've mentioned several times in my previous videos, this is a shorter term trading strategy and not an investing idea. In general, I recommend you don't invest in small cap companies. Why? Because they're too volatile. They present extremely large risks that outweigh any potential large returns you might be lucky enough to realize. Second, if you do decide to try this, don't just take all the money you want to allocate into this trade and put it in all at once. Take the money you might want to allocate, let's say no more than 10% of your portfolio, and start dollar cost averaging into the small cap ETF IWM or ARK Invest's ETF ARKK. Now look, ARKK isn't a pure small cap play, but these innovative companies will benefit both from lower interest rates and have the added benefit of the technological sea change that's currently taking place. Now, what do I mean by dollar cost averaging? Let's, as an example, say you have a $100,000 portfolio, so you're going to put $10,000 to work in small caps. Look, you take the $10,000, divide it into 5 or 10 parts, and invest each part every 2 weeks to once per month, to wherever your comfort level is. This way, if small caps continue going higher right now, then you'll at least have some of your money invested at a lower cost now. But on the other hand, if small caps go lower over the next several months or weeks, you'll be investing your money at a lower cost and buying a larger number of shares. Either way, I think this is a short-term opportunity that could last for months to maybe a year or so. But in the case of ARK Invest's ARKK, the opportunity could last longer if these innovative companies really start to catch hold. As you can see from this chart, all stocks will benefit from the Fed lowering interest rates. But the question remains, will the Fed wait too long until the economy's headed for a certain recession to lower rates? Or will they lower rates in time to head off a recession? So far, as near as I can tell, their track record over the past 64 years has been that they waited too long for at least 4 times and got it right 1 time during the COVID crisis. Hopefully, they've learned from the past and will make a better decision this time. If you found this video helpful, it really helps my channel if you like, subscribe, and share this video with your friends. This way I can continue to create future videos with insights into stock market dynamics. As you can see from the price movements and the metrics in the buying and selling pressure charts for equities, the equity markets are kind of taking a breather here. And you can see that in this chart where everything is pulling back. And look, 5-7% pullbacks, corrections as they're called, are perfectly normal. So not time to freak out and start selling everything. In fact, you should never do that. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.